Now that we've had the chance to look at an example with a cell phone, and we've reviewed all these concepts to build a theory, I think now would be a good time to talk a little bit about stocks. So let's say instead of a cell phone dropping in price, let's say it was a stock, and generally we're not going to have 100% confidence. Most of the time, if you use what we call probability software, it always begins at 50-50, whatever price you start. It says, look, it could go up or down. The defining characteristic of the stock market is it could go up or down. But the thing the software might not know about is maybe there's some news, or maybe the fundamentals are looking really, really rough, or the technicals are looking really, really rough. And so let's say our confidence isn't 100%, but let's cross that out. Let's say our confidence, though, is certainly greater than the 50% that, the coin toss of up or down. Let's just say that. And so we really feel like Acme could be in trouble. And just to keep it consistent, let's pretend that Acme is at that same price that we talked about. Let's say it's up here at $600, and we think it could fall down to that 300 level, just like the cell phone, exactly like it. So to pause here, there's a great simplicity and a great lesson here. It doesn't matter what it is that's going down, does it? It's the prices. It could be a cell phone going from 600 to 300. It could be a lawnmower going from 600 to 300. It could be a share of stock going from 600 to 300. It could be the price of a piece of gold going from 600 to 300. It really doesn't matter what the object is, whether it's stocks or phones or whatever. We could say there's this thingy. We could take away the stock, and we could say, hey, here's a thingy, or a whatchamacallit, or a widget, or a thingamabob, or whatever else it is. Something is going down in price. So really, really take the moment, enjoy that simplicity, that it really doesn't matter what it is. It's a transaction, right? You're buying and selling things in a certain order. It really doesn't matter what the thing is, as long as it's right. Now, we're going to add to this example one little thing. With the cell phone example, we were 100% sure. And so we didn't even worry about exit strategy, which is a terrible thing to do. So we are going to talk a little bit about what would happen if we were wrong in this example, and I think it'll go really well. So let's come out here, and let's do this. You have banks, right? And let's say that this person was going to go to the bank. Well, there's two things that could happen in this bank. There's two kinds of money in this bank. There's money over here that she could save, or there's money that other people have saved that she could borrow. So the bank is in the business of letting people save money, or if she wants, they'll loan her some money and leave her savings there. They'll use someone else's cash that they have to make loans. Well, guess what? In a brokerage, we have people that keep their, not an exchange, we want a brokerage, my word, let's not confuse anybody. Let's say here's the brokerage, okay, and the friendly broker there. Well, guess what? There's people that you could do two things. You could say, hey, I have a shares of Acme. Would you guys hang on to this for me, just like a bank would hold cash? Or there are other people who have put in Acme here, and the broker actually can say, we'll loan you some stock. Can you believe that? Isn't that something? So just as she could say, hey, Mr. Broker, can I borrow your cell phone and short it? When you say, hey, Mr. Broker, do you guys have any Acme stock you'd let me borrow? And that's a concept that, I would say most of the people in a 401k or even in some trading accounts don't realize, is that you can borrow stock from a broker in the same way that you can borrow cash from a bank. And it works pretty much the same way. People they have shares here that they can loan. And so let's take a look at this here and go through our 4 steps again. we're starting out with nothing in this example. And of course, in the real world, to borrow money from the bank, you'd want to have some collateral. And of course, in the real world, to borrow some shares, they're going to want to have some collateral, no question. But the fact is, we're still borrowing, right? We're still borrowing. So let's just start with nothing, just for the sake of making it simple. We're not going to list any collateral in here. We're just going to keep it simple. And we're not going to get bogged down in the details of collateral. And so the first step is we borrow these shares. In fact, I think it'd be healthy if I made just one more little copy of this. And yeah, there we go. Now we have one. First step is we borrow these shares. So let's do that. That means that we're going to borrow this share from the brokers. So there we have it in our hand right now. So I have possession of it, but not ownership, right? I have possession of it, but not ownership. And then that's the first step, is to borrow. Okay. Now the next step is to sell this stock. And hopefully our examples of bacon and eggs and borrowing money and then selling the currency for a house and borrowing the cell phone and then trading the cell phone for cash, hopefully all those examples now have paid off, because I've found that without that context, some people get a little freaked out about this. Like, how can I sell something that doesn't belong to me? Well, go back to our example, if you remember, right? Go back to our example where we said, hey, this person could borrow money and then buy a house, right? Well, they're really selling their currency. So they can borrow that currency and then trade that currency for a house. Well, in the same idea here, we can borrow this stock and then trade it for cash. We have possession of it. We don't have ownership of it, but we have possession of it. Again, when you borrow money from the bank, you don't own that money. You've borrowed it. You have possession of it, but you're free to trade it away for anything you want. Well, here's the same thing. We've borrowed some shares of stock, and we borrowed it. We don't own it, but we're free to trade it for anything we want to. And here we have an exchange, and the brokers, they will trade for us. So what's funny is I can actually make this almost one step. I can say, hey, broker, let me borrow these shares from you, and if you would, sell them on the exchange, just like that. So we borrow. Now we have a liability. We owe the broker some stock, and then we say, and by the way, sell this at today's high price at $600. So that's going to give us some cash. 100. I love doing this. It's just like counting them out here. 200. Here we go. 300. 400, 500, and $600 right there in our hot little hand there. So now, what do we have? Well, let's step her back away and take another picture of that. So now we have $600 that we can actually place in our asset column. Isn't that amazing? How we invent an asset out of borrowing. I mean, that's just really cool, isn't it? Because this money is not the brokerage. We don't owe the brokerage any money. We just owe the brokerage some shares of stock. So yeah, see how cash was created? Isn't that nuts? When you buy stock, you gotta have the cash first. But we're not buying stock. We're shorting stock. And so we create that cash right out of nothing, man. Just crazy. Borrow this. And we create this liability right out of nothing, too. So this is really interesting to pause and think about, because we were able to do this without toil in the traditional sense. I didn't have to go put in, a full, a week of work or however long it takes someone to make $600. I simply borrowed something that I had a feeling would go down based on fundamental and technical analysis. And then I trade it, and I've invented cash in my asset column, just like we did with the phone. Well, we're halfway there. We've borrowed the stock and sold it on the exchange down here, so we're getting close. And now we see Acme fall. We see Acme fall all the way down to $300, just like we thought it would. Fantastic. Absolutely wonderful. And so now what do we need to do? Well, now we need to buy back the stock. So we tell the broker, hey, we want to buy this stock back, and the price is at $300. So we're going to give someone, and we're going to make an exchange here of $300 to get this stock back. So now let's get rid of this. Now we step away, and what do we have? We still have $300 right there in our asset column. We still have it. In fact, let's make it smaller and put it right there. So we still have $300, and we have possession of the stock, but we still owe this stock back to the broker. So we've bought it back. Now the last step is to return what we've borrowed. So we're going to give the broker back the stock that we borrowed, and so that liability goes away, and we're left with $300. So we started with nothing. We're left with $300. So feel free to rewind this video as many times as you need to, and watch the cell phone video and watch this. The reason I broke this up into several different lessons on shorting is so they can be digested well, right? Now let's do one thing. Let's back up here a little bit. In fact, let's just go ahead, and we could even start over on this. So let's pull this money off, and let's just set this. Let's not pull the money entirely off the screen. I like looking at it. Let's just put it right here just for now. We'll set it over here in safekeeping. And let's do this again. Let's put the price back up here at $600. And let's do this again. And watch the difference this time. First, we're going to borrow, right? So now we owe the brokerage shares of stock. Then we're going to sell the stock, right, on the exchange. And we're going to receive this $600. So 1, 2, 3, 4, 5, $600 right there. So now we have that money in our asset column. Okay, great. Now here's the question. What if instead of going down, what if this were to go up? What if we were to be wrong? That would not be good. In fact, let's just say that this went up just a little bit. I mean, let's just say it went up to $700. That would be lame, because guess what? To get out of this trade, we'd have to trade it for 1, 2, 3, 4, 5, 6, $700, wouldn't we? We'd have to give it back more, and we'd be down $100. We'd lose $100. So just as when we go long and we want the stock to go up, if it goes down, we're in trouble. Well, if we go short and we want the stock to go down, if it goes up, we're in trouble. But here's the kicker. And there's a couple of reasons why going short has more risk than going long. This is pretty exciting stuff, but there's 2 reasons that we're going to introduce right here that there's more risk in going short than going long. If we, in fact, you know what? Let's do this. Let's take some of this stuff away for a minute, okay? And let's just talk. We can leave this here, I guess. And let's just talk a little bit about the difference between going short and the difference between going long in terms of risk. We'll bring this down right here where we can see it a little bit and get rid of some of our old stuff here. Let's see if I can do that. And we'll just keep our cash here in the corner. We like keeping that on the screen for whatever reason. Okay, watch this. If a stock is here, what's the lowest price it can get to? 0. That's the lowest price it can get to. What's the highest price it can get to? Infinity. Well, there's always going to be more risk, or what we'll say more room to go higher than there will be lower. There's always a greater chance for a stock to go higher than it can to go lower, because the lowest it can go, there's a limit here on how low it can go. There's a bounds, but there's no limit to how high it can go. Now, this is theoretical. I've been watching the markets for a long, long time, and I've never seen a stock hit an infinite price. It's not possible to do. So, infinity is a theory. No one's ever hit it. There's never been anything that's achieved the number infinity in terms of a tangible product. We can have infinite return, as we've talked about before. We can hit it there, but as far as number of dollars or number of anything, we've never hit it. But there is more upside than downside. If this stock is $100 and it goes to zero, that's $100 a person lost if they owned it. But if this stock is $100 and it goes to $500, well, that's a $400 loss to someone who is short in the stock. So there's a greater potential for loss than there is for gain. Now, don't get too freaked out about that. Just be aware of it. We don't need to be scared of things. We need to respect things. And so we want to have an exit. And so we said that with a long, and I'll just draw this freehand. We said that with a long, here's we wanted three things. We wanted an entry price. So watch this. We wanted an entry price at which we went in that made sense. We also wanted to set a target. Let's put the target in green. We wanted a target in case it went up, to which we thought it could get to reasonably. And then we wanted a smaller amount right here, which we call our exit. Remember? And so this created, let's just draw a dashed line right here. So this creates an area right here of possible reward, right? And we still don't want our long to go to zero. We'd be stupid to have it go to zero. So we're going to say, look, we're going to limit the amount of money we're willing to lose. And, we can have it gap over that, and I know, and these things, but at least at the outset, we're drawing a line in the sand that says, look, if it goes down, we've got an exit. That way we don't have the full, we still, it could still go out of business overnight and get to zero, right? But that's not as likely, right? That reduces the idea of losing it all. We could still have it gap down to zero with some tragedy, which I've never seen in all the time. I've never seen a stock gap from like $100 to zero in one day. In theory, it's possible, but we're not going to let it trickle down anyway. If it starts to trickle down, then we're going to get out. So we have our risk managed. Well, in a short, remember, it's not good or bad. It's just the opposite. So we're going to do very much the same thing. We're going to have an entry right here, but our target is going to be flipped because it's short. We think it's going down. So we're going to put a target down here, see? We're going to put a target down here. We think it's going down. But we're going to say, look, if we're wrong and it goes up, we're going to have an exit just the same. It's not going to gap to infinity. I'll guarantee you that. On the long side, it could gap to zero, but it can't gap to infinity. It'll never hit it. But we won't let it trickle up to infinity either. So here, let's draw this nicely. So here we have our same thing. We have our reward, and we have over here our risk. And so this is what we do when we're in a short position in stock, for short stock. And we want the same risk reward ratios. We'd like it to be at least $2 reward to $1 of risk, or $2 reward here to $1 of risk, either way. And so that helps us control a little bit that idea of this going to infinity. And it helps me look at the market as an opposite, not a good or bad. And if you just step back and pause and think about that for a moment, is that when you look at these two scenarios of long and short, they're identical. there's $2 of reward to $1 of risk in both trades. They have the same amount of reward and the same amount of risk as we have outlined them in this particular example. So the thing that's only good or bad is if I'm in the right position. And now it's not so much that I'm in a 401k hoping it always goes up. Hey, if things go down, I can say, well, at least I can change my position and exploit it going down. And so with Acme stock, let's run through this scenario just one more time to make it just to drive it in, right? Let's put our let's get all our little Acme stuff back here. This is going to be Acme stock, and Acme stock is trading at $600 a share right now. We think it's going down. We have a level of confidence that it could be going down. And we have these players again. We have a broker, and we have an exchange, and we have our investor. She's right here, our trader. And the brokerage has stock that they can loan. So we think that we'd like to borrow this. So we borrow the shares, right? And that gives us a liability. We owe these shares. And this happens in one click. You just simply tell the broker, I want to short. So the broker will loan you the shares and sell them in one step. Isn't that awesome? These two steps are now done automatically in the click of a button. When you say, I want to go short, they go like this. Boom, boom. Just like that. One click. I want to go short. Boom, boom. They loan you the shares and sell them in one step. That gives you 1, 2, 3, 4, 5, 6. Whoops, I'm not counting these properly. Let me use my other pen. My word, we're dealing off the bottom of the deck here, it seems. Here, 1, 2, 3, 4, 5, 6. We've got our money here. So we've got $600 that we just invented. Sure enough, thank heaven, sure enough, the price drops. So we've borrowed and sold. The price drops down here, let's say, to $300. It's time to buy this back. We've borrowed, we've sold it. Now it's time to buy this back. And so we'll buy it back. Here's $300, and we'll make that trade. So we traded back. And so now, let's pull this off. Now we've got $300 that remains. We have our stock. Now the last thing is to say, hey broker, take this stock back. We return the stock. We return the stock to the brokerage, and now we have nothing. We owe them, and we're left with a $300 profit. So I hope this was simple, and it is not normal for someone to understand this the first time it's explained to them. Not normal at all. So if you're looking at this, you're saying, wow, I think I kind of get this. You're above normal. You're above average. But it is completely normal for a person to have to go through this more than once. So if you're sitting right here and say, boy, I still don't know if I get it. I think I'm going to review this whole section. Maybe, this whole section on shorting. That would be very normal. And that's why we always have lifetime access to the 4 pillars. There's people that take this course once a year. People that take this course once a quarter. So this is a section that is really a student favorite, is this series right here on being short, because it's so different, right? It's so different to what people are used to. And it's not bad, it's just opposite. It's just different. A great exercise right now is to just grab a pen. Just grab a pen real quick and write your name. And see how that felt to grab that pen, write your name. Now hold the pen up in the air as high as you can and switch hands. Switch to your other hand. Now write your name. Is it wrong? No, it's not wrong, but it doesn't feel as good. Why? Well, it's just different. And what would be the key to making that feel good? Just keep doing it. If you began to write with your other hand and eat with your other hand and drive with your other hand and use your other hand for everything, pretty soon you wouldn't feel any difference. You'd be what's called ambidextrous. Or as my coach Rick Majerus used to say, amphibious, because he couldn't say ambidextrous. You can shoot on the water or shoot on the land. So there you go. It's just opposite. It's just different because the stock's going down instead of up. We're still buying at the low price and we're still selling at the high price. We're buying low and selling high. We're just changing the order in which that transaction is happening, right? We're just changing the order. We're selling up high and buying down low. We're just changing the order of the transaction. Why? Well, the direction is opposite, and so the order of the transaction will be opposite. Well, how in the world can you sell before you buy something? Same way you trade money for a house. You borrow it first, and then you exchange it for the cash, just like that. Very, very simple to do. A lot of fun. So I hope you're enjoying this section on shorting stock. So what have we done short with? We went short with the cell phone, and we've gone short with the stock. And again, enjoy the simplicity of understanding. Doesn't matter what it is. We could put a lawnmower here, a widget here. We could put food here, oranges, anything, apples, anything we want to put here. If it's going down, we can do this with. So I'm gonna have some fun with this. We're gonna short something. We're gonna make $100 trillion next time. So when we come back in the next section, we're going to go short and we're going to make $100 trillion. That sound like fun? Should anyone use another $100 trillion? I'm going to show you how it could be done, and we'll go out and make $100 trillion when we come back to the 4 pillars of investing.